Hey everyone, and welcome to this explainer. Today we're going to build a comprehensive top-down investment thesis on AvePoint. We're going to dig right into their business model, their financial health, and of course their market valuation. If you've been following the enterprise software space at all lately, you know exactly how critical data governance has become, right? Well, AvePoint is sitting right in the center of that storm. Okay, so here's our game plan. We're basically going to act like detectives assembling a case file today. We'll start with leadership and the business model, look at how they're solving the whole AI trust problem, audit their financials, run a reality check with a SWOT analysis, and finally wrap up with intrinsic value and technicals.
All right, kicking things off with Section 1, Leadership and Business Model, the absolute foundation. Let's see who's actually running the ship here.
At the helm, we've got a core executive team that brings a really unique mix to the table. You have deep data mining expertise from CEO Dr. Jiang, who, by the way, holds a PhD from NYU and has been driving the product vision literally since 2001. Then you pair that with the strategic, long-term capital deployment from Chairman Kai Gong. Alongside those two, Jim Senior, the CTO, is steering their multi-cloud AI frameworks, and Brian Brown, the COO, is executing the global go-to-market operations. Honestly, for you as an investor, it's incredibly reassuring to see a highly tenured, technically grounded team that successfully navigated multiple tech cycles together. Now check this out. This is what's really fascinating. Their massive enterprise SaaS engine. Notice how 85 to 90% of their revenue comes from highly predictable recurring SaaS subscriptions. One-off services and maintenance only make up that tiny remaining slice. This recurring engine is the absolute gold standard for software companies, simply because it brings massive predictability to their cash flows year after year. When you're evaluating a business model, this level of built-in revenue continuity is exactly what you want to see. Moving right along to Section 2, solving the AI trust problem. This is the big catalyst right now. I love this quote because it brilliantly captures the very real, visceral fear among chief information officers today. CIOs are actively delaying AI deployments because uncontrolled AI agents are literally running wild in their environments. It's like animals escaping from the zoo. According to industry research, a staggering 90% of organizations have delayed AI deployments by an average of 6 months, simply citing a lack of trust. Executives are terrified of an AI model silently accessing sensitive internal payroll data it shouldn't, or some rogue pilot program just burning through massive cloud compute budgets without any oversight. So how do you corral these escaping animals? Well, AvePoint launched Agent Pulse in January to solve this exact governance problem. It steps methodically through 4 things: visibility, ownership, access, and finally, cost control. First, it identifies what AI agents are actually running in the corporate environment. Second, it tags exactly who created them. Third, it locks down what specific proprietary data those agents can actually access. And finally, it monitors what those agents are costing the company in real time. It's essentially putting heavy enterprise-grade guardrails around the AI Wild West. Okay, with that catalyst understood, it's time to step into Section 3, revenue, margins, and cash flow. Let's audit the hard numbers. Looking straight at their recent Q2 2026 performance, the standout metric is an incredibly robust 27% SaaS revenue growth. That is easily outpacing their overall top-line expansion, which sat at 22%. The big takeaway for you here is that their most profitable recurring segment is the one growing the fastest. And this dynamic is steadily pushing their gross margins up into the 73% range, while simultaneously pulling their GAAP net profit up to $27.6 million for the quarter. But here is the real kicker. They hold over $400 million in net cash. For an investor, this is huge. It means virtually zero reliance on high-cost debt, which gives management the ultimate operational flexibility for aggressive buybacks or strategic acquisitions. To put that into perspective, they hold about $417 million in cash against just $13 to $22 million in total debt. Because of this pristine balance sheet, they were able to comfortably repurchase $110 million of their own stock in just the first half of 2026 alone. Now, you've probably heard of the Rule of 40, right? AvePoint executes this beautifully. They consistently sit in the 40 to 45% range by combining their 22 to 26% annual recurring revenue growth with a solid 20% free cash flow margin. This is exactly what elite software execution looks like on a spreadsheet. They aren't just burning cash to buy revenue growth. They're expanding top-line revenue while successfully throwing off significant, positive free cash flow. All right, time for Section 4, evaluating the SWOT analysis. As impartial analysts, we have to run a reality check on the risks they face out there. Diving into their strengths and weaknesses, we see high gross margins and AI data hygiene demand acting as massive tailwinds. but they are up against macroeconomic headwinds that threaten to lengthen enterprise sales cycles. It's really vital to recognize that while their 108 to 110% net retention rate proves the product is incredibly sticky with existing clients, they do face pricing pressure from lower-cost pure-play backup vendors. This basically means management has to continually prove their premium value proposition to chief financial officers who are aggressively tightening corporate belts right now. And this brings us to what I call the Microsoft paradox. AvePoint faces a classic double-edged sword. Their deep integration with Microsoft 365 is, without a doubt, their biggest strength. But Microsoft expanding its own native features, like Purview, is simultaneously their biggest competitive threat. While AvePoint correctly notes they don't have any single customer making up more than 2% of their revenue, which is great, their broader revenue is still heavily tied to the overall health of Microsoft's platform. They have to constantly run to stay one step ahead of Microsoft's baseline tools. Finally, let's step into Section 5, Intrinsic Value and Technicals. Time to combine all this data and get a verdict on the stock. So when running a discounted cash flow model, assuming a terminal growth rate of 3.1%, intrinsic value sits closely aligned with recent trading ranges. It reflects a fairly balanced risk-reward profile. At a price-to-sales ratio of roughly 6.5 and a forward EV to EBITDA of around 25 to 30, the broader market is pricing AvePoint fairly for a Rule of 40 grower. It's neither a deep discount nor is it wildly overvalued. This basically means the company has to continually execute on its growth promises to push that valuation multiple higher over time. Over on the technical side, the 200-day moving average confirms a structural bull trend, with the RSI sitting right in neutral territory, suggesting some consolidation before the next directional leg. The chart actually reflects the fundamentals perfectly here. Buyers consistently step in at that $12.50 to $13 primary support zone, treating it like a hard floor. Meanwhile, the immediate resistance at $15.50 to $16.20 marks the technical ceiling they currently need to chew through to establish new highs. So the ultimate question to leave you with for this explainer is this. Will this critical need to control rogue AI agents be the exact catalyst needed to shatter that $18 ceiling? We've seen their impeccable balance sheet, their highly profitable SaaS engine, and the undeniable fear among executives regarding AI deployment. Will agent polls be the key that unlocks that next leg of growth? That is exactly what you need to watch closely in their upcoming earnings. Thanks so much for joining me to break down this data and keep exploring.